Good morning, clients and remisiers, and thank you for logging in today's morning call. We have quite a lot to get through today, quite a few earnings updates, and we are going to feature Valuetronics, which we think is an excellently undervalued stock. Here's a disclaimer, and we will start first with an update on Croesus from Lucas.
Good morning. I'm Lucas covering real estate. So, today I'll be talking about Croetia's first. Croetia's for 3Q14, okay, they deliver what they actually promised in their, as per previously. As of start of the year, whereby it's a half year worth, they actually deliver 5.2 cents dividend. For the 3Q, which is up until March, okay, they actually delivered another additional 1.8 cents. So that brings it up to a total of 7 cents. We do understand that this is raising ahead of their prediction as compared to the IPO prospectus, but this is largely because of their 2 additional properties. It's actually something really good because they are actually fulfilling a promise of giving all the dividends, all the earnings in dividends, and they are on track to actually bringing it to a total of about 8.95 cents worth of dividend as of the full year. That will be in June, and they are on track. So largely delivering on their promises, and we actually do realize that this is a stock with even higher potential, and that's why we sort of revise the valuation accordingly based on their earnings for each and every individual more that they have. So in terms of valuation wise, it has been revised with a target price from 103. Now it's raised to about 112. We have greater visibility of the quality of the assets, the earnings that they can derive out of these 6 of them. So, for a large part, the valuation methodology should stay the same until they deliver a full year worth of earnings before we will change our valuation model. But for now, we're just looking at what's the book value that people are buying, what's the net asset value that the share price is actually commanding. So today's share price has rise from, we initiated this about a quarter ago, and subsequently we actually, another report based on their 1Q earnings is out. That was on Thursday last week, and the share price now is 96 cents. So our target price is still at 112, still quite a bit of upside to go, and even at the 112, the dividend yield will be at about 8 plus 9%. So we believe that, well, this is a very undervalued stock, and definitely in terms of, it's a very strong yield play and a very undervalued stock. So the reasons, the investment merits, we are calling for a buy based on the fact that it's going to come up above market dividend yield of 9.2%. Year to date is 7%, plus another 1.95% will bring it to 8.95 cents for the full year FY14. And we do believe that in FY15, this 8.95 cents will actually jump to about 10 odd cents, because it will be 6 properties for the full year as compared to 4 properties for the first half and then 6 properties for the second half. So we do expect higher than about 10.2 cents for FY15, and for the full year FY14, 8.95 cents. For 4Qs, and then 1.95 cents. So the second point is that there will be stable recurring income and distribution. All their properties are almost fully occupied. They command quite a good net property income. They have their leverage up about 50%, so their returns will be, their gross property return is 6%. After leverage of 50%, will be bringing up about 9%, and this will actually flow through to the investors for the year FY14 and 15, because they are distributing 100%. And thereafter, you'll be 90%. So by then, we believe that there will be further growth, further acquisition of properties, and definitely we do believe that the current income and distribution is sustainable in long term. The last point, that there's further value and growth. Management has actually represented that they are looking at additional acquisitions for the upcoming year. So they're looking at 2 or 3 other properties. So definitely is a strong undervalued play, good dividend and great growth. So target price at 112. The second counter that I'm covering for today will be CDL, City Development Limited. This is an update for 1Q14. It's sort of muted. There were no new launches, and basically there were very minor acquisition in London. So I don't think that will impact the share price. For the most part, earnings is being carried over from their previous residential launches, and they're going through the construction phase and recognizing revenue and income. So, however, based on whatever they are already doing, valuation is still good for them. My target price is 11.26, and today's share price of 10.3536 is about 34% discount to my RNAV. In terms of their major business segment residential, they have largely locked in profits from previously sold projects. Current new launch is Coco Palm, healthy level of sales because the number of units that they launch is not the full development. I do recognize that CityDev tends to be able to sell for the most of their projects because they are very well priced and they are very well located. But having said that, I do also need to highlight that there's general market weakness. For the first time, we actually do see that the developers are actually cutting the price. So they are cutting anywhere between 10 to 15% in terms of their launch prices. So this is definitely, if is any indication to go by, that market should be aware that the developers are facing quite heavy pressure on their launch prices. So do look out for that. All right. In terms of hotel, once again, the story is still intact. We expect stronger earnings from the hotel segment going forward because there's a number of their larger hotel properties that under their subsidiaries that's completing their AEIs and definitely going to resume strong operations coming up. So, yep, target price at 11.26. The upside is about anywhere around 8 to 10%. I definitely wouldn't say that it is a strong buy. We are still having an accumulate call for this counter. All right, with that, I shall hand it over to my colleague. She's covering Amara.
Hello, morning. Now we are going to give an update on the Amara. The Amara first quarter earnings wasn't really fantastic. It reviews revenue at 18 million, a drop of 27% year-on-year, and a PATMI of 3.4 million, a drop of 32% year-on-year. Main reasons attributed to no residential sales for this quarter, but there is a slight improvement performance from the hotel and investment management segment. What we think for the PATMI down, as there's actually a delay on the launch of one of the small residential project to later this year, because earlier on we actually expect it to be launched early this year. And also for this quarter, the staff and the operating expenses actually have went up slightly. For the hotel management, it is still the major contributor for this quarter. About 70% of the group's revenue balance is contributed by the commercial assets. The commercial assets are currently now 100% leased, and we see that they are actually enjoying strong, stable rental income with the office and retail outlook still going strong. For the second half of this year, Amara Bangkok is still on schedule to start the operations. For this, we believe as the hotel revenue normalizes, we should be able to see a significant contribution to the earnings to Amara Group starting for end of this year to early next year, and so. So with the fundamentals intact, we still believe that the share price, there's still potential upside for the share price of Amara. We maintain our buy rating with an unchanged target price at 70 cents. Next, we will be covering on OUE. OUE first quarter PATMI has actually went up to 945.6 mil, mainly with the gain from unlocking the value of the Marina Orchard Singapore and Mandarin Gallery. Mandarin Orchard Singapore and Mandarin Gallery, sorry. Based on the revenue, it actually went up 1.5%, higher contribution with the addition of Lippo Plaza property and the US Bank Tower. The hospitality division cover 50% of the revenue, and the investment property about 41% of the revenue. OUB H Trust was consolidated following the distribution in species of the OUE H Trust in the first quarter this year. What we feel that with a strong cash holding of 860 million. OUE main activities will be to seek higher value development activities. One is the potential joint venture with the Lipo Limited and Casual Entertainment Corporation in integrated entertainment resort in South Korea. Or AI activities. Potential is the partial conversion of the US Bank Tower to residential units for sale, and also a conversion of the one tower of the Twin Peak to rented apartment services. And besides investment into higher value development activities, another portion they will also be actively looking at is to unlock the capital, unlock the value of the stabilized assets through divestment into their OUE REITs. So for this, we maintain our accumulate rating with new price of 2.59 after factoring in the special dividend, special share dividend payout. Next, we move into commodities. First is the First Resources. The group revenue actually was up about US 178 million, mainly due to the higher sales volume from the refinery and processing division. However, EBITDA was lower because of the lower contribution from the downstream business with the tighter refinery margins. First quarter net earnings actually reported at 45 mil, a drop of close to about 30%, accounting for 20% of our estimate, which is lower than our estimation, mainly due to the declining margin with the lower selling prices and also higher cost of sales. We expect the downstream business margin to remain tight with the overcapacity of refinery facilities and the tight CPO supply in Indonesia, but it will be offset partially with improved upstream business performance from the improved CPO prices in 2005. So the improved CPO prices in 2005 will underpin the First Resources growth in the coming quarters. We maintain accumulate with a revised target price of 2.65 based on DCF valuations. Next, another company also released result last week is Golden Agri Resources. The group revenue was up 34%, thanks to a 6% year-on-year increase in the realized CPO average selling prices, coupled with the sustained palm sales volume growth with the CPO production up 4% year-on-year on recovery in year-end contribution from the 8,600 hectares of newly matured oil palm areas. First quarter net earnings at US 104 million, accounting for 22% of the Phillips Securities full year estimate. Despite higher upstream production and selling price, the bottom line is partially offset by tighter refinery margin in palm and lauric division, and also negative crushing margin in the oil seeds division in China. So while we expect the China operation to remain volatile over the next quarter, the performance should be also offset by the upstream plantation business underpinned by higher production and expected higher average selling price. We maintain our neutral rating for Golden Agri at target price 0.55. Next, I'll pass over to my next colleague.
Hi, morning everyone. This is Colin, and I'll be giving a quick update for results for first is SingTel. At least fourth quarter revenue was down 8% year-on-year, and which was mainly due to lower revenue from Optus as well as the weaker Australian dollar. For the full year, revenue was down about 7% year-on-year. However, on the positive note, net profit for the quarter was up 4%, and that's lifted due to effective cost structure that leads to improving margins, as well as the gains from these regional mobile associates, mainly Bharti Airtel, as well as gains from the Singapore consumer business in mobile IPTV, as well as fiber rollout. For the full year, net profit was up 4% year-on-year. However, adjusting for the exceptional items, the underlying core profits was flat. Remains rather flat. So how this is mainly due to lower mobile revenue from Optus in terms of the Australian currency terms, as Optus continue to face a decline in subscriber base, and also mobile revenue was down due to this mandated mobile termination rate reduction in Australia, as well as a weaker Australian dollar against the Sing dollar. No surprises in dividends, as dividends was maintained for 16.8 cents for the year, which is similar to FY13 dividend per share. We are still maintaining our neutral rating for SingTel due to concerns over Optus as well as currency headwinds. We do not expect a quick turnaround in its digital business, as SingTel will still continue to invest heavily to build up its mobile advertising business, and hence you can expect to see expenses in the digital life segment. Okay. However, growth will still likely to come from its mobile associates as well as the Singapore consumer business. So we are having a revised target price of $3.75 due to based on our sum of the part valuation. Next, on MoneyMax, first quarter revenue was up 46% year-on-year, which was mainly lifted from its trading revenue due to disposal of its accumulated pre-owned jewelry and watches that were deemed unsuitable for retail sales. However, the first quarter net profit was down 72% year-on-year, mainly due to higher advertising and promotional expenses. Okay. That was mainly due to advertising promotion in conjunction with its IPO as well, and MoneyMax is still going forward. It will still continue its advertising and promotions till to the mid of 2014 this year. Trading revenue also contributes much earnings yield, lower earnings yield as compared to its retail sales, and hence that results in the fall in net profit. Okay. Going forward, MoneyMax will still continue to focus on launching more new outlets. In fact, since the beginning of this year, 7 new outlets were actually launched as part of its strategy to reach out to wider customers. However, this will probably take some time to build up the loan balances in each outlets, as these are mainly new outlets and not acquisition of the traditional pawn shops. In view of the cautious outlook of higher expenses as well as the uncertainty in gold prices, we have downgraded our rating to neutral for MoneyMax with a target price of 33.5 cents. Okay. Next, I'll hand over to my colleague on update on ComfortDelGro.
Hi, good morning. This is Richard. Okay, I'm going to update on ComfortDelGro. So ComfortDelGro recently released its first quarter results. Revenue year-on-year increased 9.2% to 950 million, and operating profit increased 5.8% year-on-year to 102 million, and net profit increased 9.7% year-on-year to 63 million. What we see is that the bottom line growth outpaced the top line growth, and that revenue growth in all business segments except car and rental grew. Their revenue was further boosted by positive forex translation. Bus and taxi accounted for 65% and 27% respectively for their revenue growth in this quarter. The operating profit growth came mainly from the bus business. This primarily is from their UK bus business, where their newly acquired Metroline West is being consolidated. On the not so positive side, their domestic rail and fare revenue bus business continued to register operating losses, but these losses were reversed by profits from their rental and advertising business. We remain positive on ComfortDelGro for its exposure to profitable overseas businesses. We maintain an accumulate rating with unchanged target price of $2.34. Next is about SATS. So SATS recently announced that the acquisition of the Singapore Cruise Centre will not be going through, and they were quoted as saying that it's due to market developments in Asia. What these market developments are is that there's a trend of larger ships, and these ships are not able to berth at the Harbourfront Terminal, which is operated by Singapore Cruise Centre. The Harbourfront Terminal has got a height restriction due to the cable car at the area there. So this development of larger ships is not a problem for Marina Bay Cruise Centre, which SATS already operates, because it does not have a height restriction. What we have done is that our previous estimates had assumed that the SCC deal would go through, so now we have stripped out all the future contributions from that SCC acquisition and revised the target price downwards to $3.37 while still maintaining our accumulate rating. But we wish to highlight that SATS will be releasing its full year financial results later this week on Thursday, and so target price may subject to change again then. Now we move on to Pan United.
Thanks, Richard. An update on PanU's first quarter results, which were a tad disappointing. Revenue was up 7% year-on-year, with even contribution from all three business segments. However, net profit was down 5.4% year-on-year, and this was mainly due to a 10% rise in raw material costs, which outpaced revenue. What happened was that in February, there was a temporary export ban by the Indonesian government on unprocessed granite, resulting in Pan United having to purchase granite from further afield and buy from the Singapore government stockpile, as its own quarries could not export. However, the ban was very short-lived and was lifted in March, and Pan United expects that some of the lost margin would be recovered, as RMC prices typically taper slower than the RMC prices typically taper slower than the selling price of input costs. Singapore government's productivity drive was also the other thing that affected work, in that projects are now taking a much longer time to complete, and that means the consumption of RMC is slower. Now that also means that because construction projects are going to take longer to complete, it also means that the infrastructure cycle is going to be much longer than I think people anticipate, because the demand is still the same, right? By the fact that the Singapore government still has a very large public infrastructure projects ahead, okay, which is quite likely to offset slowing private residential demand. Okay, so that means the cycle will draw out longer, and that means earnings will be spread out over time rather than front-loaded. The other driver is that port earnings are expected to double by FY16 as CXP integrates the new acquisition CCIP. So our target price is very minutely changed from 135 to 133, and it's based on 12 times earnings for 12 times forward earnings of FY16. Pan United trades at an average of 12 times PE for the last 2 years. Now SodaStream.
Hey guys, Kenneth here. Update on SodaStream. Okay, so basically, keep it simple. The first quarter results came out, and it's essentially in line with the expectations of the company and management. First quarter was supposed to be weak because of the hangover from last quarter's weak sales in the US. So essentially, you have revenues has actually increased year on year. That's great. But EBITDA and net profit, because of foreign currency exchange as well as greater depreciation, essentially is still flat. Okay, it's just 1.8 million for net profit. Okay, but this was actually guided by management. The diluted EPS is actually 8 cents, which actually did beat estimates of 0.1 cents. Now, what's interesting to note is that George Soros is actually accumulating SodaStream. It was just announced that in last quarter he accumulated about $24 million of SodaStream, and he accumulated it at an average price of between $40 and $41. Okay, now in terms of performance, we see the first quarter results were in line, but US sales decreased by 20%. However, sales everywhere else outside of the US is having very, very good growth. As you can see, Western Europe, Asia Pac, and Central, Eastern Europe, and Middle East is all having strong double-digit growths here. So what we can say is that the US sales was slower than expected. It's not that good, but outside the US, sales are extremely robust. Okay, so it shows that this is definitely still a growing product. Now, interestingly enough, unit sales for the soda makers itself was down 22%, and this is due to the US sales slowing down. However, unit sales for CO2 refills increased by 22%. Now, if you recall, CO2 refills, this is what's going to drive future earnings. Okay, margins on soda makers is actually low, right? So the fact that CO2 refills is up 22%, it shows that the world is actually using more of their machines, and these are repeat customers, because refills are only what the repeat customers are buying. Okay, so market penetration slowed down, but this CO2 refill increase shows that, hey, there's a regular usage, and this is not a fad. So the guidance for this coming year is actually unchanged. The company still maintains the same guidance, which is here. So essentially, you're still going to have a 15% increase year on year in terms of revenue growth. Okay, EBITDA, okay, is actually going to increase 25%. Okay, that gives you an idea of the operating growth that we're having. However, the net income, okay, reported net income for 2014 is supposed to be only 3%. Rationale is because of forex weakness as well as the increased depreciation. But operationally, they are still growing. So we still maintain an accumulate rating at at recent price at 40.92 with an unchanged target price of 46. Now remember, the last time I initiated and the last time that I had updated, I told you guys that for the short term, 46 was a reasonable target, because what you're paying for is that you're paying for potential. You're paying for the potential of a recovery back to historic growth rates or some sort of M&A partnership. Okay. Now, if you've been tracking SodaStream, you'd know that in the past 1 month, actually this target price of 46 was hit already. The price actually hit 46 twice. Okay, that's the nature of the volatility of SodaStream. Okay, so I still reiterate the same call that on the short term, it's probably worth accumulating until 46. And the only way for, and this is just based on potential alone. So only when the potential gets realized will the price go up further past 46. But 46 is reasonable for the potential it has. Okay. But in any case, if you do buy SodaStream now, at least you have a partner called George Soros. Okay, so Valuetronics. Okay, so we're initiating Valuetronics today, which we think is deep value. Okay, deep value, yeah. So what's so good about Valuetronics? All right, let's take a look at this, shall we? Okay, so Valuetronics, right? We just think that it's too much value to ignore. Simply put, the PE x cash is 4.0 times. That's extremely deep value, and we think that earnings will be at least single digits for this year and the next year. So we have stability of earnings plus a great margin of safety. Okay. To put it case in point, a PE or x cash of 4.0 implies that in 4 years' time you would have made back all your money if earnings stay the same, which is a great margin of safety. Okay, let's go. All right, here's a quick snapshot. As you can see, this snapshot is essentially the revenues, etc., for continuing operations. Okay, that means the operations that they have right now. Okay, and what you'll notice is that you have a nice steady growth. Okay, steady growth going forward. This last column here is the 9 months 2014. They will report the full year results coming soon, I think on the 27th or 28th of this month. Right, but as you can see, they almost hit almost hit last year's target, last year's amounts already. Okay. So right now, the 12 trailing month PE is actually 5.6 for 12 trailing months. Okay, this is extremely cheap and undervalued, and we'll tell you why. Now, the thing about this is that 50% of its market cap, not equity mind you, market cap is net cash. Okay, that's essentially 18 cents per share. Taking a very conservative estimate that half of this cash is idle, okay, that's 9 cents, right? Gives you a PEX cash of 4 times, okay? We'll go through this valuation again later on. But let's talk about the company itself. Here's the price chart, and if you notice, technically speaking, okay, that right now price has actually broken through its 3-year high. So since it's 3-year high in sometime in June 2011, you see price has actually gone through some sort of double bottom, and you've actually broken this. What does this mean? This means that on this breakout, you have this breakout, and then you have this ascending triangle formation. If this is a true ascending triangle, if it is, the technical target on this breakout is actually 40 cents, just to let you know for the technicals. Okay, Valuetronics. So Valuetronics essentially has a host of services. Essentially, they are a EMS, electronics manufacturing services company, but they do value add by a few other things that we're going to talk about. Okay. All right. This is overview. So they provide OEM. This is traditional. OEM plus and ODM services. OEM is original electronics manufacturing. ODM is original design manufacturing. OEM plus is what they call their OEM, but they provide value-added services to attract clients, to make them sticky, and to have slightly better margins. This is what they're aspiring to basically develop and increase. Now, they do these range of services via 2 business segments, the consumer electronics, which is the CE, and the industrial and commercial electronics, which is ICE. Okay. Okay. They've been actually in the business for 20 years, and just in 2012, revenues have crossed $2 billion Hong Kong dollars. Okay. Since 20 years ago, plus, Valuetronics grew from an integrated EMS provider towards a premier design and manufacturing partner for the world's leading brands in the 2 segments. They serve multinationals and mid-sized companies in the commercial, industrial, telecom, medical equipment industries in US, Europe, and Asia Pacific. Okay. Profile for its revenues is such: the CE segment is 70% revenues, okay, but lower margins because of volume. ICE segments is 30% revenues for now, but operating margins are much higher. As you can see, and that's what's the reason why they're concentrating their marketing efforts on the ICE segment. At present, okay, there's a concentration of product for CE. The LED lamps make up 40% of all revenues, and the printed circuit board assembly for shavers and toothbrushes is 20% of all revenues. These 2 things are both in the CE segment. Okay, so you have this for the CE is weighted on these 2 things. Okay, what's the investment thesis? There's 3 points. Okay, 1. We talked about this earlier. It's got a net cash accounting for 53% of its market cap, and we estimate conservatively that half of it, or 26% of market cap, is idle cash. Means they don't need it for their operations. They could basically give it away as a special dividend. They could use it for share buybacks, or they can even use it to expand themselves. Okay. That being said, if you do that, then the PE, but the actual PE right now is still attractive at 5.5. That's the amazing part. It's already attractive even with the cash. But without the cash, the PE drops to 4.0. Earnings growth likely to be single digit, and and this is a conservative estimate, and we'll show you why later on. Now, 2, Valuetronics shows ability to maintain revenue and bottom line growth in continuing operations X the loss-making licensing business segment. Those who are familiar with Valuetronics know that in about 2012, they tried to expand into the licensing business segment, and this was loss-making, and that put a drag on net profits. Okay, but since March 2013, they have fully written off this loss-making segment. Okay, so now that this is no longer on the segments, the only operations are the continuing ones. And if you track the performance of the continuing operations, you'll see that both CE and ICE have increased by 27% and 18% sales CAGR respectively. And actually, the continuing 3-year net profit CAGR is actually 26%. And this is from FY10 to FY13. So actually, their continuing operations have been seeing steady growth. They've also managed to mitigate the increasing cost pressures in China, which is affecting a lot of manufacturing, okay, with cost-cutting projects and lean manufacturing. And that's the reason why their net margins are actually been above 5% for the last few years. Now, that's pretty admirable considering in this EMS space, the typical traditional margins is around 3, but they've been managing to keep it more than 5. Now, there is a stability of income that comes from the LED lighting because the LED lighting takes up 40% of all revenues. So we have to look at the LED market in itself to see if there are actually tailwinds or headwinds. And what we find is that the LED lighting market at this point in time is actually burgeoning at a value sweet spot. Okay, right now LED markets is considered, or the LED retrofit lamp market is actually into early expansion into the mass market, which means that there will be rapid expansion. Okay, the projections for the general market is that by 2020, the monetary value of the market should be 64 billion euros. Note that it was only 9 billion euros in 2011. That's explosive growth, and right now we're into 2013, 2014. According to a report from McKinsey, 2013 to 2016 is considered the sweet spot for manufacturers in terms of monetary value. And that's essentially where Valuetronics is right now in 2014. Okay, so this does provide a good tailwind for stability of revenues, supports revenues in the next 2-3 years. Okay, quickly, key milestones. So 1992, that's when it was headquartered in Hong Kong with manufacturing facilities in Tan Sri Town. Of course, since then, they've moved their primary manufacturing site to Daya Bay in 2007. Okay. So essentially, in 2012, their revenues have crossed 2 billion Hong Kong dollars. Okay. Interesting to think of note, in 2005, they became Philips, the electronic company. They become one of Philips' preferred suppliers. Okay, so in 2005, they became essentially one of 8 global preferred suppliers for Philips Electronics. Okay, so this gives you a hint of the type of quality or competitive advantage that they have. This is their business model. So essentially, they started off doing OEM, which is very traditional, and these are the type of services that they do under OEM. Okay, but they're trying to move up the value chain to OEM plus and ODM. Right now, they actually do have ODM, but it's a very small part of their product mix. Okay, ODM essentially means that they are the original designers. They design, and other companies essentially place orders on their designs. Right now, they're focusing on value adding on OEM plus, and this is where essentially they can help to value add to the client by helping to suggest improvements to the client's designs, etc., etc. And they do value added things like they design for manufacturing, they design and build test fixtures, they do testing, they do rapid prototyping, they do regulatory compliance, and they also help with supply chain management should the client needs. So they're trying to outsource. They have a research team, quite a big research team of engineers, and they're trying to outsource these value-added things to have a more sticky business and to also have synergy or have a competitive advantage versus as they deal with their clients. Here is a sample of their design and development capabilities. So they do mechanical design, plastic tool design, electronics, RF and software designs, regulatory compliance, engineering and testing, and product test development. Here are the manufacturing capabilities. They do plastic tool fabrication, injection molding, metal stamping and machining, printed circuit board assemblies, including complex multi-layer boards, sub-assemblies and full product assemblies, that's the full box build. They do reliability, engineering and testing, quality systems, materials procurement, and on-site program management. So a whole host of manufacturing capabilities. This is basically their primary manufacturing site at Daya Bay. Okay, it's quite a big site, 110,000 square meters, right? But interesting to note that in these buildings. This building over here, B3, is actually empty. In other words, they can still expand their present capabilities without having to acquire new land. Okay, they already have an empty building here to fill it with machines and process engineering facilities. Okay, here just a small sample of their products. Here the LED lamps that they do sell. Okay, they basically do the assembly service for this. Okay, and here are the shavers and electric toothbrush. They essentially do the PCBAs for it, as well as some assembly work on this. Here's just a pic of their thermal laser printers production. Okay, due to client confidentiality, I cannot say who their clients are, right? But the client that produces the LED lamps and the PCBAs is essentially one of the top 5 global manufacturers, okay, for these products. Quick note on reclassification that from 1st of April 2012, they used to report their segment results under OEM and ODM, but it's been reclassified to CE and ICE. Okay, so they've basically decided to change how they report their earnings from functionality, which is OEM and ODM, to where the product's actually sold, like which client base are they selling it under. Okay, and the reason why is because they're starting to use OEM and ODM. The line is being blurred into, they're using both into essentially both segments. Their third loss-making segment, licensing, has been discontinued and written off since March 2013. So there is actually no surprise that net earnings have improved since. Okay, let's now look at the operating segments itself. Okay, so here's the CE operating segment. Okay, so essentially for this segment, it's quite concentrated. 40% of all sales is on LED lighting, 20% on shavers, right? And the last 10% is on miscellaneous. Now, the thing is, that actually bodes well for Valuetronics in the sense of tailwinds, because, right, that means that the CE sales will be supported by the robust state of the global LED lighting market, as well as the global GDP growth, because LED lighting will be affected by these two things. Now, for GDP growth, we know that it's estimated to be 3.4% CAGR in real terms till 2016. That's the estimation. Okay. The LED lighting market, okay, is considered to be in the manufacturer's sweet spot. Okay. Now, we talked about this earlier, about the size of the markets. So let's just look at this one. The LED retrofit market value, which essentially is where those LED light bulbs will be used, okay, is a subset of the general lighting market. Okay, so its market is estimated to be 690 million euros in 2012. Okay, and it's like 190 million euros in 2011. Okay, so as you can see, the growth rate from 2011 to 2012 is going to be quite high. Okay, LED lighting markets in early mid expansion phase to mass market, where the cheaper prices is spurring robust sales. So the estimation is this: as with all new technologies, when they try to render another product obsolete, there's obviously a market penetration curve, and where we are is actually early mid expansion into the mass market. So characteristically of this, right, you will see a big sales increase, okay, as the price of your product decreases. Okay, so to 2016, according to a report from McKinsey's, there'll be a 40% CAGR in terms of sales, okay, because of worldwide penetration to the mass market as price falls. Okay, so that means, but here is where we estimate the actual monetary value of the market. So if you're looking at the bottom numbers here, you will see that because with sales increasing but price decreasing, right, there'll be a certain point where the monetary value starts to decrease, right? Okay, where the price decrease will supersede the increase of sales, and that seems to will occur at 2016. So as you can see, monetary value of the market will actually grow, and its highest growth will be around 2016, and then after that, the monetary value of the market will drop. Okay, so between now and 2016, this Valuetronics seems to be in this particular sweet spot. Okay, here's just a chart to give you an idea of the lighting market growth rates. Okay, so this chart here is simply the global lighting market growth rate. Sorry, the global, so it's whole lighting market. So this includes not just the classification of general lighting, automotive lighting, and backlighting, but it even includes LED as well as the older light bulbs, the incandescents, etc., etc. So this whole market will increase by 5%, okay, year on year to 2016, followed by 3%. It slows down between 2016 and to 2020. That's for the whole market, 3 and 5% growth. However, when we look, but at the same time as the market is growing, the LED market share within the lighting market is also growing. So you have growth on growth, essentially. Okay, and the estimation of the growth rates, right, is here, 33% and 15% of the LED growth rate. Okay, so the LED growth rate is growing as the whole market is growing. Okay, and so that's why we say we're in a sweet spot right now. This chart is to show you that the lighting market is essentially correlated to real GDP. Okay, so as you can see, lamps and luminaires are simply complete lighting systems. Okay, you can see that both of these are positively correlated with real rates in GDP, which is great because we are still considered to be in bull market phase. GDP is expected to still grow by single digits, so that bodes well for markets. So increase of GDP means there's probably going to be new installations, whether it's office or residential, and the more installations there are, the more lamps will be used. Okay, just one note about the LED market. So the LED market is definitely expected to essentially render the old light bulbs obsolete. It's not just because they are energy efficient, as we all know that, etc., etc. But many countries, like even China, have policies which encourage the use of LED lamps because of energy savings and going green, etc., etc. Okay, some tailwinds, right? Okay, here are the tailwinds. To reiterate, LED lighting's current position in the product life cycle bodes well. Improving global GDP also bodes well. If both estimations go without a hitch, right? Top line growth can actually grow as much as 20%. Okay, but just to be conservative, right? I'm gonna be extremely conservative, and I'm gonna account for any unexpected turn in the business cycle, right? I can assume that the longer growth rate will just be 1%. Okay. All right, operating segment. This is the other segment, the ICE, or Industrial Commercial segment. For this one, they have a very diversified portfolio. Okay, as you can see, and it's very diversified in different functions, functionalities, different products. You have slot POS, point of sales, and teller station machines, all the way to cold chain temperature monitors for ICE use. As you can see, it's a whole range, which bodes well on the type of flexibility that they have to entice these medium-sized companies to outsource their manufacturing to them. So the strategy for ICE is that they typically seek out small to mid-sized companies, roughly 500 million or less revenues, who are leaders in their segment and who are thinking about outsourcing their manufacturing, and typically have a small design or development team. This is so that not only can they outsource manufacturing to Valuetronics, they can also utilize Valuetronics testing and design team as well. And this is how they're going to Valuetronics increases their competitive advantage and have slightly better margins. Now, encouraging to note that last year, it's reported that 2 ICE customers have already shifted their production over to Valuetronics. One is a GPS Precision customer, and he shifted their North America production over. Now, it's more interesting to note that the intelligent temperature control ICE consumer found it cost efficient to shift their PRC production over, right? So it shows the type of competitive advantage that Valuetronics has. Okay. Now, Valuetronics is focusing on this higher margin segment for obvious reasons. They're focusing their marketing on this. Okay. So essentially for the trailing 12 months, we actually saw a 20% top line growth for the ICE segment. because the I segment essentially has a whole host and a wide portfolio of various manufacturing products for industrial use, we found it fitting to just to take a look at the global PMIs, manufacturing PMIs, okay, and we estimate that the global manufacturing PMIs are actually improving, cycling up. So this also bodes well for this ICE segment, okay. Now, though recent year had a 20% top line growth, we actually conservatively assume a reasonable 5% growth going forward, and this is to account for unexpected macro risks and the lack of an order book. So, one common problem with this EMS stocks is that they don't have a visible order book, and so there's always this sense of uncertainty. Okay, but we still feel that with all these tailwinds going for it, great valuations going for it, it far outweighs this risk of order book. Okay, so short-term risks and long-term risks. So short-term risks essentially is that yes, Valuetronics is sensitive to the business cycle. Okay, both segments. There is a single client concentration risk because that one client does take up between 40 and 60% of revenues, and there's also a small cap risks. I mean, small caps are more sensitive to business cycle compared to large caps, right? So there's usually more earnings volatility. The longer-term risks, okay, are such that future success depends on these abilities. I mean, they have to adapt to changing marketplace, so they do have to keep making sure that they are relevant to the evolving technologies out there. Okay, so that they can be a good partner for their manufacturing. They do have to think about finding ways to offset the eventual LED lighting profitability decline, which will probably happen, after 2016. After 2016, it's not like the market will collapse. It's just that the market will slowly shrink, right? So they have a few years essentially to change their product mix or to find more clients. Now, so far, they have been using lean manufacturing and efficiency improvements to combat cost pressures in China. They've done a relatively good job for the past 2 years. They started 18 months ago. So one wonders how much more they can do. Okay, so this is their challenge. So anyway, to account for all these risks, right, we place a very conservative 25% discount to fair price. And this is a very conservative because even in our growth estimations, we were already conservative. So we're even being more conservative because we're very kiasu Singaporeans. Okay, so on the valuation section. Okay, so now we talk about valuations. Okay, so basically, estimated FY14 earnings will be 190 million Hong Kong dollars. Note that they shall be reporting end of this month, and the 9 months earnings are already 108 million, which is 78% of this target. So this is a very attainable target, easily obtainable. And if so, then based on, closing price on Friday, PE was 5.5 times. Okay, so now we compare to peers, all right? So let's just go to the peers. Let me jump for a second. So here are the peers. So based on peers, we compare companies, contract manufacturing companies and electronic manufacturing companies. We compare the ones with similar market cap, okay? And we find that their average PE is roughly 7.8 times PE, okay? Now, Valuetronics is right here, and you can see it's trading at a much better, cheaper PE, 5.5 times, which is interesting because you can see that their 3-year net margins, right, is 5, which is actually higher, is better than average for most of these companies, okay? And they also did it with no leverage whatsoever. They've been in net cash for many, many years already. So they managed good margins at 5%, good earnings for continued operations, and they did it with a cash pool with no leverage. That's quite good in our opinion. Now, in the peers, we actually took out Venture Corp because Venture Corp is much larger. Market cap is, it's 10 to 20 times more than the rest of the companies in terms of size. And because Venture Corp is much bigger and has a much longer history, it commands a much better PE, which is, as you can see, is 14 to 15 times PE. So actually, if we had put Venture Corp into this matrix here, right, the average PE would even be greater, which is even better for Valuetronics. So even this pure PE that we're pegging it to, we think that even that's conservative as well. Okay, so let's go back here. Right, so comparing to peers, Valuetronics performed admirably with net margins more than 5%, which is higher than the typical 3% for the traditional contract manufacturers. They did it without leverage, and they also never turned out a loss-making year since IPO, since before IPO. They have never actually turned a loss-making year. So we think it is actually more than fair that they trade at peer average of 7.8 times, which is excluding the bigger caps like venture. And that implies a value of 48 cents SGD. Now, at the idle cash of 9 cents per share, okay, which is conservatively estimated 50% of the net cash position, right? Actually, in theory, in terms of enterprise value, they could probably give up all their cash because all their receivables, right, actually outweigh their liabilities. All their current receivables, right, actually outweigh all their payables. Okay, so in terms of enterprise value, they can actually give out all their cash. But we are being very conservative here, and we just assume that 50% is what's idle, and we assume that the company needs the rest of the 50% just for operation's sake. So add this 9 cents in, you get a total value of 57 cents, which is actually conservative. But then, because we are very kiasu Singaporeans, right, we conservatively account, I think I've said conservatively too many times already, okay, but anyway, we account for the unexpected macro and concentration risks. We apply a 25% discount to this, right, and you end up with a final fair value of 43 cents. And this is essentially almost a 30% upside from Friday's closing price of 33.5 cents. Okay. So this was the peer comparison which we talked about. Okay, and we are done for this part of presentations, and we shall welcome any questions. Because of my time constraint, I'd like to answer all the Valuetronic questions first. So just give it a few seconds for questions to come in. Okay, questions. All right, some questions. Who are their major shareholders and shareholdings? Just note that we initiated the report this morning. So for more details, right, please refer to that report. But their major shareholder, basically their major shareholder is Ricky Chong or Chong Hing Zi, who owns about 19% of the company, and he's the CEO. So the CEO actually owns a big portion of the company, followed by Gok Kik Chow, who is a director. So between these two people, right, the director and the CEO, they actually own more than 35% of the company. Now, dividend payout track record is this. They don't have a fixed dividend payout policy. They're supposed to come up with one soon, but historically, they seem to give out 30% or 40% payout ratio of their earnings as dividends. Now, that implies roughly 5% dividend yield right now. But historically, they have given out special dividends as well. So I would expect actually 5% or more dividend this year and next year. Okay. Question says, Valuetronics looks great, but the market is putting substantial risk premium on the stock. Why is this undervalued? Okay. Here's it's a good question, and I'm going to answer that right now. It's my FAQs. There is a lot of perceived risks of this stock, and I'm going to address 3 of them. Okay. Hopefully, this will just give you an idea of the risks and the responses to it. Okay. The first risk, most obvious risk, is concentration risk. It has quite a big client, right? And what happens if that client pulls out? That's one worry. Okay, well, let me just say this, okay? This particular client is actually one of the top 5 global manufacturers of lighting. Okay, that's one. Okay, and Valuetronics actually produces 90% of certain types of their LED lamps. So this company actually has sell a whole portfolio of LED lamps, and Valuetronics actually supplies 90% of a few of those. Okay, so they are the primary manufacturers of those designs, which makes them which makes Valuetronics in a sticky position actually. Okay, because even if that MNC producer wants to pull out for whatever reason, right, it will most likely be done incrementally and not immediately. Okay, now, but not just that. Valuetronics was actually one of 8 global preferred manufacturers shortlisted. Okay, that means they have been identified by this MNC as one of 8 global preferred manufacturers, and they've had a relationship since 2005. Okay, so that's to address the concentration risk. Okay, there is a long-standing relationship there. Okay, and just based on the nature of what they're producing, there is a certain element of stickiness to it, and any pullout cannot be done. Probably will not be done immediately, but incrementally anyway. Okay. Next, that's our first risk. Second risk could be typical EMS, right? Low margin, right? So people probably look at Valuetronics and go, it's EMS, so it's probably low margin. And since everyone's been talking about China's cost pressures, low margin plus cost pressures equals disaster. So I think a lot of people have been probably scared in the past because of that. Well, the thing about Valuetronics is historically, Valuetronics has been operating above 5% net margin for years. Okay, that beats the typical net margins of 3% for the traditional EMS people. Also, historically, even before IPO, they have not even made a loss-making year. That also includes the financial crisis time as well. Even during financial crisis, they have not gone into the red. Even when their licensing business was bleeding, they also were not in the red. And that's also the reason why Valuetronics in the near future and above is focused on developing higher margin ventures like OEM plus services, okay, that utilizes the added services, and they're particularly going to focus on the ICE segment, which has higher margins. So right now they're trying to transition to higher value services. Finally, the last risk most likely for this type of EMS companies, right, is that there's no order book. So because there's no order book, there's this sense of lack of clarity and no one knows, what next quarter is going to be like, etc. Well, this is the case for most contract manufacturers, right? However, some points to note. The manufacturing LED and personal care products, right, is actually for a top global manufacturer, you see, and thus this allows revenue correlations to the global economy. So there's already a sense of a a scale here, right? It's a proxy to the global economy, which is actually good. Now, and this is good because we mentioned that there's an estimated 3.5 annual GDP growth that provides tailwinds for both the CE and ICE segments. Okay, and of course, because of the type of products that they are doing for this global manufacturer, it's also correlated to the LED product cycle. So yes, there's no order book, but we can give a good estimate of the tailwind or the support of sales because of the type of products they're selling and the position that they have with the supplier, because they're providing, like for example, they're making 90% of a particular type of LED lamp. So I hope that clarifies why there might be a lot of perceived risk and what the responses are. So that being said, even with all these risks, right, we conservatively dropped forecasts for growth. We also gave a 25% discount to fair price, and we still ended up with a price of 43 cents. And don't forget, 43 cents is still pegged to a PE of 7.8 times, which is still cheap. There's a question on where margins are going. Okay, we think that margins will stabilize at 5% based on their current operations, and at this point, based on current operations and based on where they are focusing their marketing efforts. Okay, don't forget that they are focusing their marketing efforts on the ICE segment, and the ICE segment has much higher margins. So they're focusing essentially on changing their product mix, and they're going to continue doing the lean engineering and optimization. So we think that it's reasonable that they can maintain this 5% net margins, at least for the short term. Another good question is that one of their directors actually sold off quite a bit of their shares in April. Okay, there's one of the founders, right? That's a good question, and the question is why. Yes, good question. We found out. So essentially, that particular director, right, was way beyond retirement age of 55, and essentially he was 60 plus already, and essentially he was pulling out based due to retirement. Okay. One thing to note is, so the director sold off, right? But the other two significant shareholders, the CEO, etc., they still kept their big stake. A question that says, Valuetronics, what is the reason for the price to increase by 2 cents today? Well, the report came out today. That could be a reason. But at the same time, I believe that Philips is the only one to cover Valuetronics actively at this point in time. Most of the other research houses had ceased coverage on Valuetronics months ago. Just a quick update. The link on the daily report on Valuetronics has been fixed. Okay, so the email link is broken, but the link on the morning note has been fixed. So you can find it from there, or you probably can log in to Poems itself to get the report. Okay, another good question. How conservative is it to strip off cash? They've always been in net cash since IPO, etc., etc. Okay. Now, to answer your question, it's quite simple. If you look at historically, historically, if you look at the net cash positions they've had, right, compared to, let's say, their cash to their total assets or cash to their operating assets, if you take that ratio, you will see that even though they've been in net cash all the way, they have operated on a smaller ratio before. So if you look at some of the years, they've actually had less cash than usual. Okay, and don't forget, they actually have been accumulating cash for 2 years. If you look carefully at their financial reporting, so they have been actually collecting cash. So it's very easily that they could reduce their cash levels to what it used to be like, and so they still have cash to give out. Okay, that concludes the questions for Valuetronics. Okay, so we're gonna answer the rest of the questions now. Okay, so hold on. For OUB questions. Oh, Ben's on here. Let's see. OUB questions. Sorry, I mean UOB questions. UOB. Hey, that's it. Sure not. Okay, a quick question on U.S. market. Is the U.S. market undergoing correction these 2 weeks? Okay, well, actually, what I mentioned last week, I still reiterate. And the thing is, so the U.S. market was consolidating. At that point in time, people were getting a bit bullish on it. But for me, I felt that there was still too much underlying weakness in the breadth indicators, as well as when I look at the